Mahesh Patil is now joining in to run us through what he's making of things and how he's seeing the markets coming through. And he's Chief Investment Officer at Aditya Birla Sun Life AMC. Mahesh, it's a pleasure.
Yeah, good morning.
Great to have you with us here, and thank you for coming in. How are things looking, Mahesh? Are you, a lot of fund managers we've spoken with, especially, your colleagues over at, not colleagues, but peers over at Kotak, they've been sounding the alarm bells and caution as far as the broader markets go, mid and small caps, etc.
Right.
Are you as concerned, or you think it's a longer runway here?
Yeah, so I think there's no doubt that the market in the last few months, we've seen a steep rally over there, and arguably, because of the liquidity which has been there, right, both domestic as well as foreign, we've seen stock prices go up, and more so because a lot of inflows in the last 6 months or 1 year has been, especially domestic flows, have been in the mid cap and the small cap segment. In the mutual funds, almost like 40 to 50% of the incremental flows are in that category, and that has led to some kind of a, outperformance, right, in that space. But I think if I look at from a slightly medium-term view, I think India, overall the outlook on growth is looking fairly decent. Despite the global slowdown concerns which you might see in the next couple of quarters. And the good thing is that a lot of sectors which are participating in that. It's not like one or two sectors, it's more broad-based. If you look at right from the banking sector to the investment cycle now, which is picking up after a long time, the real estate sector, even pharma for that matter, and even the IT sector, right, which is likely to get the brunt of the slowdown, looks to have bottomed out over there, right? So given that, I would say that the market still has longer legs. When you see a sharp rally, there is some pullback, which would always be there. But even in the mid-cap and small-cap segment, it becomes more stock-specific then, right? The broader market or the index might look a bit expensive, especially in the small-cap space. But there the universe is very wide. You need to look at new ideas over there. And I think while the valuations look expensive on a trailing basis, but I think if India growth story plays out as we think, and if you have stability, that elections are there next year, but if the election results are good, I think you could have a long runway of growth for India. So in that scenario, the earnings growth in mid-cap and small-cap would be much stronger.
So they're not expensive, you're saying? despite the run-up, you're saying that
yeah, it's expensive. One can see you can't sell and again get in, right, into the market. That's always difficult, even for fund managers and even for investors. So, don't go aggressive, stick to your allocation. I think that should be the mantra rather than trying to get out of the market.
Okay, since you're talking about mid and small caps,
yes.
My colleague Nimesh is waiting by. He has a company on his radar, Restaurant Brands Asia. So let me just go across to him and I'll come back to you for your thoughts on that. Nimesh, over to you. Why are you tracking this one?
Hi, Sonia. So there was a 25% block which got done in the block window today morning. I hinted as well that there's going to be a large block in Restaurant Brands Asia. What I understand from sources, the promoter entity, which is private equity Everstone, they sold 25% stake in today's block deal. Since the block happened in the block window, it do suggest that the demand was quite strong. But I understand 90% of the book was bid by the long-only funds, and only 10% was given to the hedge funds. Now, the Everstone, the private equity owns close to 41% stake in Restaurant Brands Asia, and they've sold it at 25%. So nearly 70-80% of the stake they've sold by a block deal. And again, this has been the trend. After a large block, the stock moves up. The fact that the demand was quite strong, and also for QSR overall in general, looks like the quarter 3 and quarter 4 are going to be quite strong. So there is momentum now, but the fact is in Restaurant Brands Asia, what I understand from sources, the promoter entity Everstone has sold today 25% stake to institutional investors.
For that, so that's on Restaurant Brands Asia. But Mahesh, I wanted your thoughts on this. For the mid and small cap space, you're saying that there's still perhaps a longer runway, right? So how do you sift the wheat from the chaff? What are the pockets that you would look at? What are the sectors that you still like despite the rally?
Yeah, so I think, again, one can't take a shorter-term view over here. I think you have to be slightly careful because few stocks, because of liquidity, we've seen a sharp run-up over there. But I would look at companies, where the runway of growth is much longer. I think some of the cyclical names, which have run up, I think there could be probably in this kind of run-up when there's a downturn, you could see a larger kind of drawdowns over there. So structural stories, right, where say for example, again, whether it's in the consumer space, right, we've seen a lot of good mid-cap and small-cap companies coming into the market recently. And India, we believe that the consumption story really, the discretionary consumption would have a long runway of growth. I think we are at an inflection point where your per capita GDP is now at around $2,300. And short term, there's weakness because of rural slowdown, but I think that should also come back. And in fact, getting into election, you will see a lot of spending happening, right, by the government, and which could drive consumption. So if you look at sectors where the runway of visibility is good, so even if there is a short-term correction, I think you would not really panic and want to sell out, right? You'll use that opportunity to add in.
Sure.
So stocks are sectors where the conviction is higher, runway of growth is better. I think those are sectors which we would like to own. Though I would still caution that, one needs to be cautious over here, right? In that, not be aggressive and look at it, wait for the opportunity, don't chase price point, because we've seen, any slight positive news or liquidity and the stocks just run up. I saw today, right?
Yeah, and then they
10%
correct.
up.
I was just noticing that I think on railway stocks, the correction is hardly 15-20%.
Yeah, so
after a run-up, which is 200%.
Right. So that you have to be careful in those pockets, right, where they run up and valuation. I think valuations, fundamentals, needs to again look at it and see. Market, you're not going to get stocks cheap, right?
Sure.
Because the liquidity in the outlook is good, but at the same time, reasonable, some consideration for the outlook growth. But I think that framework, if you keep in place, I think one should be fine.
So, Mahesh, let me ask you one thing. What is the risk to this market? And I'm not going to ask you about inflation, because inflation is a consensus. And when there is a consensus known risk, people say it no longer is a risk because the market knows that you're working with that. Aside of some complete tear in inflation, we're talking about crude at 94, monsoons are doing what they are.
Right.
Apart from that, is there anything else that we're missing?
So I think, if you look at the concerns really are from the global side, because that's where the sharp increase in interest rate happened, right? The increase in interest rates in the US is historical. We've not seen in many decades. And that could lead, while US growth is still fairly good, we have seen not any major shocks, but that kind of interest rate, and it could remain for longer. Our view is that rates will remain higher for longer. And that could lead to some kind of a blowout. We don't know, right? These are unknown, as you rightly said. The known risks are already there. But the unknown risk is what you should be worried about. And that kind of environment, you might see some kind of a blowout which could happen. We saw some scare some time back, right, in the regional banks in the US, but that was more of a liquidity issue which was immediately averted because of a backstop by the central banks. But there could be some blowouts there. And the risk would essentially come from the global market, where you could see a risk off and you would probably have a collateral damage over here in our markets.
Mahesh, so which are the slightly longer runway, still good levels kind of areas? What specific pockets, if you can identify?
Yeah, so I think one is, I talked about the consumer discretionary sector, which includes all the retail, consumer durables. They are currently going through a slowdown, but that's a good time actually to look at it, because
durables.
Consumer durables,
right.
Then retail sector, right? All that space.
So durables, you mean white goods and stuff?
White goods and others.
Voltas and Whirlpool and...
Yeah, these are stocks which are currently still going through the competitive intensity and this thing. But again, if I take a 3 to 5 year view, that sector should see a reasonably good growth runway. Apart from that, I think even the power sector for that matter.
Sorry, you said retail, and there you mean what kind of names? Just to give an example.
So retail could be apparels, footwear, right? Even other retail companies, which are there into, say, jewelry. So all that segment looks as good, more from a structural long-term perspective. Power is another sector which we are seeing after a long time sizable investments coming in, both in the thermal as well as on the renewable side. And that could another be a sector where...
But where, again, in power?
Utilities are still reasonable, I would say.
Okay.
The challenge in utility was that growth outlook was not that great earlier. But now the visibility of growth is looking much better. So they offer a reasonably good risk.
We just
reward.
had Sumit Kishore of Axis earlier, the analyst. He said valuations are kind of now, they've run up.
Right.
So he said
right.
the sprint phase is over, his words, and now it's a longer, more calmer kind of phase.
I agree. So I think now in the market, you have to really look at stocks, which will compound and give you steady return. And they're trying to chase big returns over here, and the market could be also risky. So you want companies where the runway, as I said, growth is fairly recent, and you play on that compounding, right? Anyways, on the broader market, we are not expecting any large returns, right? Our expectation return market is that it will be somewhere near its kind of a long-term average, 12-13%. So any stocks which give you better than that with reasonable comfort, I think should be a good investment.
Do you like the equipment space as well? Power equipment?
So power equipment also should do well. Only challenge there is that a lot of stocks have run away quite a bit, right? So again, it's a question about then a balance between the valuations and the outlook, right? So you have to get both the things right.
We have a discussion coming up with HPL Electric. I mean, the smart metering opportunity in the power equipment space.
Right.
Do you own any of those sort of names in that?
Unfortunately, because it's a very niche and small segment, there are not too much opportunities over there. So we would normally look at some of the broader plays. Pharma also looks good over here, again, as a good defensive. And in fact, I will not be even negative on the IT sector, right? Because that's a sector which has been talked about a lot. A lot of negatives are already priced in. And the whole runway to digital, I mean, the move towards digital is going to be a longer term theme. It's not going to be like a 1 year. So we have seen currently a slowdown in discretionary spends in the US. But I think you've seen some of the companies getting some large ticket wins also on the cost takeouts. So again, good cash flow generating companies, reasonable dividend yield. So again, a good defensive, I think, in that sense.
I wanted to, by the way, I just want to point out that Bajaj Auto is the stock that you should really be looking at. It's up almost 4% right now. It's a fresh high that Bajaj Auto is sitting at. And, Nimesh was telling us about how BofA Securities has gone ahead and upgraded Bajaj Auto and talks about how now Bajaj Auto has surpassed that 5,000 rupee mark, fresh record high there, and how most of their businesses now are firing on all cylinders and they're looking very good, even in, the premium motorcycle space, the EV space. They're picking up quite a bit of pace there. I wanted your thoughts here because this whole electric vehicle space has blown up, right, in the last couple of weeks and months. I mean, the sector is doing well, the ancillary stocks are doing well. Most of them are at all-time highs, whether it's M&M, Bajaj Auto, even the ancillary guys. Is it too late to enter here, or do you think there's more to go?
So auto sector has done fairly well in the last 1 year, right? Across, we've seen a good recovery there, especially in, say, commercial vehicle. It was four-wheelers, and now it's the two-wheeler space, right, which was kind of lagging behind. And we have seen decent, and again, the stocks, especially in two-wheelers, were fairly reasonable. They were not really that expensive. So I think, and again, the only challenge was the disruption, right? Most in the two-wheeler space, because that's where the adoption of EVs has been much faster. So I think, but now probably the landscape is getting more clearer, right? Which are the players which have got space also in the electric vehicle space, and market is trying to distinguish that in the marketplace. So again, on the auto sector, I think we think that the valuations there, right, are now pretty much factoring into that. Now it will be more of a steady compounding there, right, in terms of how the volume growth is going to be, where the market share shifts will be. I think that will drive
some of these stocks like Bajaj Auto, for example, valuations are still not much higher than what their historic mean is. So do you think in that sense there could be more headroom?
So stocks like two-wheelers is the only sector, right, within the whole auto space is where it is still reason because of, as I said, the disruption fear, right, which was there on the electric vehicle side. And then others, some of the players have got a large amount of exports, right, which is there. So the outlook on exports there, right, is also important in terms of sometimes exports can actually balance out, right. In the domestic market, you might be losing, but exports could be doing better. But I think the companies which are able to really transform and able to have, say, even the electric EV space, to that extent, they are hedging, right, in terms of trying to protect their market share. And those are the companies, I think, which one would like to bet in the auto sector.
Mahesh, I think the million or billion dollar question that's on everyone's mind is that why have banks gone quiet? I mean, now the bank index is more or less moving in line with the Nifty, but we haven't seen that, blue-blooded leadership that this market is used to every time it hits a new peak. That's not happened this time around. What's the chatter that you hear among, large, investors, your peer set, when it comes to picking bank stocks? Why aren't we seeing that gold rush that is usually the norm with every rally?
Yeah. So I think banks, I would say is slightly over-owned sector, right? So it's been fairly overweight. Most of the domestic as well as we see, foreign will be slightly overweight. So that's one of the technical reason I would say. But apart from that, I think banks had a very good run last year in terms of earnings growth. Because last year they saw a large improvement in their net interest margins when interest rates came down, right? So now when interest rates have peaked out and your cost of funds are going up, so you would see this year will be a period of consolidation where your NIM will probably compress a bit.
So consolidation of earnings or consolidation for bank stocks? Because that has a market connotation.
So one is consolidation earnings, right? So which automatically means some amount of... But I think banks offer the very good risk reward at this point in time. Because the credit growth is still fairly good. I mean, we were expecting that this year credit growth will probably come down because nominal growth is much lower. But it's still fairly good. The credit cycle is still behaving well. I mean, the corporate side is really very benign. On retail side, there have been some murmurs that unsecured lending is seeing a very strong growth. So RBI has also cautioned a bit, but we don't see any real fears at this point in time. So I would say that rather than, and within the banking space, the shift is slightly more towards NBFCs because going forward, NBFCs will now see a margin expansion because as rates have peaked out and whenever rate cut happens, you will see that play out in the NBFC sector. So that has actually some money has moved to the NBFCs and they have done much better in the last 3 months.
All right, Mahesh, thank you so much for joining us here in the studio. Have a great weekend and thanks for speaking to CNBC TV 18.
Thank you.
Thank you.